Wall Street is watching Korea's chip giants, and they're taking sides. Goldman Sachs recently surveyed U.S. investors on Korean semiconductors. Far more intense than what's happening in Asian markets. Here's what's dividing Wall Street right now. On one side, the bears. They warn that memory chip prices could peak as early as Q2 2026, with a potential downturn hitting by late 2026 or early 2027. On the other side, the bulls. Their argument? This cycle is fundamentally different. Samsung Electronics posted earnings in Q1 2026 that surpassed its own annual records from the legendary supercycles of 2017 and 2018, when operating profit hit 53 and 58 trillion Korean won, respectively. If Samsung can do that in a single quarter, the old valuation playbook may no longer apply. Then there's the LTA debate, long-term supply agreements. Historically, when chipmakers start signing LTAs, investors treat it as a peak signal. Customers locked in contracts at the top, then walked away when the cycle turned. But Goldman Sachs pushed back. This time, customers are begging for supply, not the other way around. With prepayments and price floors written into contracts, the chance of another mass cancellation is, in their words, extremely low. So, who do U.S. investors actually prefer? Samsung or SK Hynix? The answer is nuanced. Overall, a slight majority favored Samsung Electronics. Why? 3 reasons. First, Samsung has a higher share of commodity DRAM, meaning more upside when the market recovers. Second, Samsung has taken the lead in HBM4, high bandwidth memory for AI. Rival production ramp-ups are hitting delays. Samsung has already started mass shipments. Third, Samsung's shareholder return policy is more predictable, and there's room for more. SK Hynix still has its fans, though. Investors who prefer it point to stronger share price momentum, attractive valuation relative to ROE, and a potential ADR listing in the US that could trigger a global re-rating. One more wildcard, TurboQuant. Google recently unveiled a memory compression technology that raised fears of lower AI memory demand. But most investors dismissed the concern, citing what economists call the Jevons Paradox. In the 19th century, when steam engines became more efficient, coal consumption didn't fall. It exploded. More efficiency unlocked more use cases. The same logic may apply here. Better memory efficiency could expand the total AI memory market, not shrink it. Still, risks remain. New cleanroom construction is nearly impossible to complete within the next 12 to 18 months, which limits sudden supply surges for now. But investors are watching China closely. The pace at which Chinese firms enter the DRAM and NAND markets, combined with a wave of new supply expected after 2028, has Wall Street on guard. For now, Goldman Sachs reports that most U.S. investors are choosing caution, holding their current positions rather than aggressively adding Korean chip exposure. The chips are on the table. The question is, who blinks first?